If you're watching this video, I want to thank you for once again or for the first time supporting freechartvideos.com and supporting the daily S&P updates that I provide the investing community free of charge. And by golly, it's worth every penny. So what I want to do first off is to remind you that charts are not by any stretch infallible. That if you think you're getting some predictive, well, someone's calling. As I was saying before the phone rang, I don't remember. No, charts are by no means infallible. You might think that things are just going to work perfectly, and then it absolutely bites you. I would say that a chart is kind of like it's like a skilled putting your finger, a licked finger up into the air, and you're getting an idea which way the wind is blowing, how hard, from which direction, and then you start to take measurements of direction, measurements of flow, and anyway, it's a little bit like being a weatherman. You get a general feel for things, and you think you know where the front's going. You think you know what the temperature's going to be, but it's never done till it's done. But there are some things that I want to share with you in this video, and I want to remind you that these things are still for educational purposes only, not to be used as any form of investment advice. I just draw lines on charts. You have to decide what to do with your money and why you do what you do with your money. I am not a licensed professional. I'm just a guy that draws lines on charts. So let's look at some charting theory. Okay, what are we looking at here? I think most people would say, well, it looks like a stock chart, and it is a stock chart. But I want to encourage you to think about charts maybe a little bit differently than what you're used to. While it is a stock chart, and it does record the fluctuations in the price of stocks, it also is a record of human behavior. Really, when I look at a stock chart, I look at it like this is a record of the way bulls and bears have fought out the perceived value of something that has sometimes a value that's very difficult to arrive at through fundamental analysis. So this is a chart of Glue Mobile. They do mobile gaming, and I've made a couple trades in Glue, been some pretty good ones, and it looks like Glue has made a pattern that's known as a triangle bottom, an ascending triangle. The top is pretty flat, but the bottom rises, and that broke out. And if you know the story, you know that I'm expecting Glue to get to 10. But what do we learn from this? Well, the first thing is we have talked about the importance of using a chart that you can actually get a good read on. And one of the things you need to do in order to get a decent read is I think you need to be using logarithmic charts. For example, if we look at Glue Mobile on an arithmetic chart, I want you to look at that just for a second and tell me how you're going to figure out what to do with that. What does this line mean? Where did the trend actually change for Glue Mobile? So if we look at it on an arithmetic chart, we just get this very strange looking flat bottom, and then some exaggerated moves coming into it, and then what will probably end up being exaggerated moves coming out of it. However, if we go to a logarithmic chart, watch what happens to this descending line right here when we go to the log chart. I mean, look at the difference between that and that. Now, why do we use logarithmic as opposed to arithmetic? Well, first off, let's describe what the difference is. An arithmetic chart, and follow this as closely as you can. An arithmetic chart shows a $1 gain no matter where that gain takes place as the same vertical distance on the chart. Okay? In other words, if $1 goes up and when it goes from 20 cents to $1.20, that's a quarter of an inch height on the chart. Well, if that stock goes up to $1,000 eventually, and then it goes up to $1,001, that's another 1/4 inch move on the chart. The problem with that is this. I don't think, and I believe history bears out, that people do not trade stocks based upon the arithmetic. They trade stocks based upon percent gain. So if you buy a $5 stock and it goes up $1, you're looking at a 20% gain. You're probably going to be thinking about selling or taking some of that off the table. However, if you bought Apple at, what is Apple trading at now? Shoot, I haven't looked at it in a while. Hold on. I was going to say 330, but it's 337. If you buy Apple for 337 and it goes up $1, are you thinking about selling? Are you going, man, I don't know, man, that's $1 I made on each share of Apple. I better get out of that. That's some pretty good profit. Of course not. You look at that and you go, whatever. But if it's a $5 stock, you look at it and you go, hey, that was a nice move. I think I may want to take some profits. So that's what an arithmetic chart where it can trip you up, because it shows that $1 move in Apple as being as significant as a $1 move in a $5 stock. Let's tell you what. Let's look at Apple real quick. Okay, here is a logarithmic chart of Apple, and you can see that there are some. I've got 2 touches, actually 1, 2, 3 touches on this top line, 2 touches on the bottom line. Apple, to me, frankly, looks like an ascending wedge, and it's going to set itself up for probably a pretty strong correction one of these days. But the fact is, there's still a lot of room in this wedge for it to not lose the interest of investors. So there's Apple as we look at it. Since 1984. By the way, you could have bought Apple for about $1.80 back in 85 rather. Man, I wish I had. So anyway, let's look at it now as an arithmetic chart. Okay, I'm just going to get rid of these lines because they make absolutely no sense right now. You look at that and you say, oh my goodness, Apple is getting ready to absolute crash. There's no way you can keep that parabolic move going. But you look at it on a logarithmic chart and you go, oh. So this really tells the picture. Now I'm going to warn you about something. There are some people who have blogs or have some political interest or some socio-political interest at heart. Sometimes I've seen people who want to try to paint a very bearish picture, or they want to scare somebody with an editorial piece. Sometimes these people will use an arithmetic chart because they know it makes things look more exaggerated. So, for example, if instead of Apple we were looking at the growing U.S. debt, I might want to use an arithmetic chart. And I'm going to go, look, debt was absolutely flat until 2005. Then look what happened. It has skyrocketed. All right, now let's look at it again logarithmically. Okay, I said debt was flat all the way from the beginning until 2005, but that arithmetic chart masked the fact that that this $1.70 back here actually had gone up about tenfold, more than tenfold, and that move was almost completely masked. So I'm looking from here to here. Tell you what, let's snap a vertical line. There's that low. There's that high. And again, if you had bought back here at about $1.80, you would have been up to $34 a share right here. All right, but watch when you look on an arithmetic, it looks like, well, that's just some little bump there. That's not just some little bump. That was your stock that just went up 18-fold from here to there. But the arithmetic chart, because it has gone up so much more in terms of dollars, all of this movement is being masked, and this movement is being exaggerated. So that is why, rule number 1, I use logarithmic charts. They show the percent gain in a correct graphical representation. Okay, now let's talk about trend lines. To begin with, I think you'll find that trend lines are much easier to draw on a logarithmic chart than on an arithmetic one. We also, when we draw trend lines, we want to make sure that we are picking points that really make sense. Okay? And by the way, trend lines get trampled on quite frequently. I mean, they're pretty much, they're not infallible. You can't draw a line and say that's a line in the sand and it will never be crossed. But as we look at Emeritus Corporation, which, by the way, about a couple months ago, I mentioned this stock. I said that it had gotten up to the solid into the mid-20s, I think about 26, and that I was looking to buy it on a pullback to around 22, and I have done that. But as I look at this chart, I'm looking for things that line up. Now, what about this candle right here? This is a 2-day chart, by the way. Well, you could, draw this and say, well, that kind of lines up there. And, I probably would have been drawing that line at some point. But as we get down to the bottom here, well, yeah, that kind of works. So we had this pattern that broke down. That this support broke down, and then it came back for a pretty decent rally, getting back, but could not overcome this previous high right here. Then it sold down into a really deep funk, getting down under $5, and is now rallied back. Again, as we look at this, we draw a line here, down here, and let's zoom in on this a little bit. You see what I've done? There's a top, a top, a top, a top that finally broke out, then went sideways, and then went up. And I think that that was a significant move when this line got taken out. And you can see there was a back test, and then it rallied, formed for a number of months what really, in retrospect, is a pretty long bull flag. Now, keep in mind those people who were in the stock who bought at this high around 1450, when they saw 11, they weren't thinking that was a bull flag. But it's called a bull flag because it has a tendency to result excuse me, in a bullish outcome, and it sure did. Then there was more consolidation that took place, and you can see that had we been drawing a trend line here up through there, you can see that it came down. Let me get that just right. Took that line out, but then did a back test, right? And then has gone sideways, made another pattern here. And the whole thing, to my eye, is a large inverse head and shoulders consolidation. Now, I want to show you just one thing real quick here, because we talk about, and we did this in the last video, we talked about head and shoulders patterns, how you establish the neckline, which is the 2 points to the left and to the right of the head, and that's whether it's inverted or standard regular head and shoulders. You extend that line, and that line should provide support. And in this case, it appears, at least at this point, that that support was found. Now, you might want to ask yourself, why? I mean, I think it's pretty clear that this is often the case. By the way, interesting thing here is that a lot of times with these patterns, there's symmetry. We got a double left shoulder, sort of a double head, and a double right shoulder. So that does not make this pattern twice as powerful. As a matter of fact, it has a tendency to create a little bit more of a meandering move after the pattern. But that aside, why do we get this phenomenon where resistance, once broken, turns into support? Well, the reason is pretend like you had some emeritus stock, and let's say that well, first off, why does resistance turn into resistance? All right, let's start with that first. Let's say you had emeritus and you bought this at $12, and it ran on up here to what is that? Low 20s, and you said, man, this thing's going to just keep on going. Well, all of a sudden, no, it didn't. It sold off over a number of weeks, and you're going, well, I'm not really willing to sell here. And then it sells back down, and you're going, God, why didn't I sell when this thing was in the 20s? And then it starts to come back. It starts to come back, and it gets back up to the lower 20s. Not quite where it was before, but you say, now's my chance. Well, you're not the only guy who says now's my chance. A bunch of other folks say now's when I'm getting out. So, because I missed the chance back here, so I'm getting out now, and this leg down is all of these people getting out. And the fact is that that is resistance, because that is a point at which people have an interest in liquidating their shares, because they missed it back here. And in some cases, it's because people bought here and they were smart. They saw this line and they said, now's the time to get out. Well, as it comes back down, people who maybe thought, well, you know, I wish I had bought back here because this thing really showed me more than I thought it had. If this ever gets down around 15 again, I'm going to buy it. Well, guess what? It did get around 15 again, and it got bought up. So this is now support. This is an area at which people say, this is a good place to buy, and the 20s is a good place to sell. Well, this came up again, started getting around 19. I think people probably said, I don't want to get greedy, I'm going to sell here. But other people said, no, I'm going to wait for that full 20. Well, this time, because this pattern took out a lot of supply as it sold down to the 15 level, this time it just kept on going and it took out that resistance. Okay, so now we're looking at 21, rough 21.22, as being an area that, by golly, I wish I'd known those people who sold here, here, and here. Once it got over that, they were going, dadgummit, I sold at 21, 22, and this son of a gun kept going to 26. If I get a chance to get back in at 21 or 22 where I sold, I'm going to buy this thing back. So that's what they did, and I think that's why we get this bounce here. So the psychology in these trend lines, and this slopes down a little bit. It's easier to understand when they're almost horizontal. But the fact is, there's also underlying buying and selling pressure that will take a line like this and rotate it up or down. And I think there's just like this overall bias that create these descending or ascending trend lines. In this case, this is about as close to horizontal as I could find in a stock that tells this nice little picture. So, what do we look for now in Emeritus? Well, what I'm looking for, first off, and I think it's pretty easy to expect this, is I'm expecting a move to the low 30s. As long as this bounce stays good and strong, we can even draw a trend line here and say, well, look, all that junk kind of matches up, doesn't it? All that lines up. And not only that, we got a peak here and a peak here, and that is almost perfectly parallel. So I'm thinking now there's a trend established that's going to take Emeritus in this channel eventually to meet this target, and it probably will be somewhere near the end of the year. In the long range view of things, this pattern's pretty big. If it has its say, then Emeritus has a long way to go beyond just this small implication of the height of this consolidation here. Okay, now we are looking at BioCryst Pharmaceuticals, a stock that I abhor. I hate this thing because it does not behave, but there was a point in time when it did some pretty predictable things, and that's why I want to use this to get into some terminology. A lot of times we'll talk about, or at least I'll talk about an area of congestion, and sometimes you'll hear the word consolidation. Other times you'll hear the word building a base. Sometimes you'll hear the word reversal. And I think sometimes people will use these terms at times, particularly the term consolidation. I have to catch myself. The term consolidation actually means a pause in a move that creates some sideways action that then leads to a resumption of the move that took place before that pattern was formed. Okay? So as we look at BCRX BioCryst, let's take a look at a couple things here. The first thing is we can see that that BioCryst was in a down trend from 2008 and into 2009. You can see that it got a little squirrely, tried to get up over this, but actually this move above this trend line right here, where it went up, down, and then down more, we might be tempted to think after a downtrend that anytime that line breaks that we're definitely getting a reversal. But in this case, this pattern right here, if I can just kind of roughly define it with a few lines, this pattern right here actually ended up being a consolidation. BioCrystal was in a downtrend. It went sideways for a little bit. That ended up being a consolidation that then broke down and it continued down. All right. Then there was a pattern that developed, and let's define it. And again, it's not a perfect pattern here. Let's just kind of take those two lows right there. This actually made kind of a double bottom. And once this trend line was taken out, this ended up being a reversal. Now, until that move, we would not know if this is going to reverse or if this is just setting up for more downside. You really don't know. Additionally, if we take this line and draw it here, you can see how this is almost like call it a descending megaphone pattern. Oh, come on. See what I'm looking at? It's almost like this whole thing is a broadening pattern, but once it breaks out, then it leads to what should be a pretty good move. And you can see here, again, remember, we're talking about a breakout that clearly took this line out, and then a pullback. And why did it bounce there? Well, because all the people who sold here, here, and here, when it took out that line, and this guy right here was thinking when he sold, he says, this sucker's going down to $1.25. I'm going to buy it back and ride it on back to $2 again. Well, when it surprised him and got all the way up to $4, all of a sudden this guy's going, Lord have mercy, was I boneheaded or what? I sold all my shares, right around $2. If it ever gets down close to $2 again, I'm not going to be stupid. I'm going to buy BioCrystal. I'm going to buy back. So, all the people who sold here, not realizing it was going to go up to 4, they piled on and they rode this thing back up to 4 again. And what did we get right here? Well, this is a little flag, a bull flag. And what is this? Well, this is a consolidation. This pattern went up, it consolidated for more upside. Now, there's a funny little thing about bull flags, and this isn't always true, but it's amazing how often it's true. If you look at the move that led to the formation of the flag, and I'm just going to go from here to there. Actually, we probably should go from where that leg started right there. Yeah, that really is where that move began. So if you look at that move, and then you got that bull flag, it's funny how often the flag flies at half-mast. Because once it got over this, where did it go? It made this the midway point of this move, of this total move. Now, once we got up here and this thing was banging up on 12 and 13 bucks, what did we get at the top here? Well, we got a little double top. However, while this was forming, did we know it was a double top? Or did we think that it's possible this was a consolidation? Well, yours truly bought here. And I ended up getting out, probably I didn't get out all the way on this pullback, but I was expecting there to be 6 turns in this thing like is typical. And so I ended up losing a little bit of money. I made a little bit of money from here to about there. But what I did isn't really important. But, so what do we have? This was a consolidation. This was a reversal. This was a consolidation. And by the way, that down-sloping pattern, when you see that pattern after a nice run up, and it's a controlled pattern, the chances are pretty good that bull pennant or bull flag is going to play out exactly as it should. But when you get up here and you start batting back and forth and there really is no clear bias one way or another, I mean, I guess I could make the claim that we had this going, but the fact of the matter is this was a pretty deep move here from around 12 to what, 750 or so. So I think expecting that to be a bull flag is not being realistic. Turns out that was a double top. The double top broke down, pulled back. Why did it pull back to this level? Well, because the people who didn't hold on a second, let me clear my throat. The reason is because people like me, the people who got caught in this downward move off of this line right here, they said, hey, man, I got really messed up here. I bought this sucker at what, $9, and all of a sudden now, oh my goodness, what happened? Well, those of us who were patient and waited a little bit for a pullback a couple months later or a month later, we said, okay, here's my chance to get out with a small loss or to get out even. And you can see that it then sold down again, came back to that same level. Why did it not make it above that this time? Same thing. People who said, I should have taken my chance to get out even here. I got another chance. I'm going to do it here. And then a third time that happened, then you can see that this thing has been in somewhat of a spiral ever since. Now, I think I'm done with BioCrystal because I just, I got a bad taste in my mouth about this. But if we look at this pattern, at the rough trading pattern, since all of this took place, it really doesn't hold that well, but you can see this whole thing is in a pretty large descending wedge, and I almost guarantee you that one of these days or one of these years you might come back and look at this and say, boy, I wish I'd bought this in the $2 range, because now it's back up and who knows really where it could go. But right now I'm kind of staying clear of some of these large descending wedges, because there's just so much selling pressure in this thing. Even when they break out, they have a tendency to come back for a series of back tests and just still keep going down. But the BioCrystal gives us a good opportunity to look at what is a consolidation and what is a reversal. Why do we get these back tests? Why do lines of resistance continue? Why do lines of support continue? And plus, I'll remind you, if you were looking at this on an arithmetic chart, good luck, because it gets a little screwy looking. This one holds together better than some, but it still gets funky. Okay, now we're looking at a chart of Baidu Incorporated, and what I want to show you in this chart is here's the thing we want to learn here, and it's pretty simple. That when you have a clearly established channel, the behavior from breaks in that channel differ as it relates to the underlying trend of the channel. What do I mean by that? If you are in an upward channel and the top line breaks, as it did here back in May of 2010, it is absolutely no problem, and it's easy for the prices to come back down into that channel. Okay, so if you have a break, an upward break from an upward channel, don't expect that top line that got taken out to offer a lot of support if things start to sell back down. As a matter of fact, it usually offers very little support. Okay? So remember, a break from an upward channel to the upside, that top line cannot be really counted on as support. However, a downward break from an upward channel, you can usually count on that broken lower line as providing, from that point on, resistance. Okay? This was your resistance line as this was coming up, right? So that resistance line in a rising channel does not necessarily turn into support. As a matter of fact, you really just can't count on it. However, a rising support line, once it's broken, then that usually turns into resistance pretty reliably. Let's look at another example of this. Okay, this is another example of what I was talking about a break in a trend. And I want to show you, this actually comes from a true story. And I was looking at Rensola, and I was seeing these patterns develop. I said, that was an awfully strong move right here. It got up over this this line, trend line, over these two tops from January and March of 2010. And I was just kind of doing the draw the line thing, and I'm going, okay, well, these bottoms sort of line up a bit. Let's just kind of see what happens. And once this broke out of this little triangle here, I'm thinking, well, a lot of times you get a return to that top line or the apex. So let's snap that right here, horizontal line. So by golly, when I saw this little wedge form right here, I thought, well, this looks like this thing may be a buy, but I don't know. I think I'm going to wait just a little bit. So I watched it and saw it get up here to over $6, and then it pulled back and came up here and worked its way sideways. Well, by now I was thinking, all right, let's see what we get in the way of a channel. And basically what I did, I'm going by memory here. I think I bought on this candle right here. Saw this line and I snapped kind of a parallel line down here, and I thought this is probably going to be a channel. So I bought this thing in the 7s, and as soon as we got up to this tag here in the 9s, I sold. I think I missed the 10, and I sold on one of these candles here, probably for $9.70 or something like that. So hey, wish I could do that every day. But then what happens? I watch this thing just completely blow out of the top of this, what I thought was going to be the channel. Now, truth be told, that ended up being really the truer story about why that was a top and why this was not. But, until this created itself right here and turned back, I was not willing to take that line and extend it and say, well, that's how far it's going to go. I was working within this channel. But you can see that it got over this line, and then what? Well, it got a little bounce, and then it just completely took this whole thing out. So a kind of a word of caution. Sometimes when you get an upward channel and then you get a move that comes up out of that resistance line, sometimes that's setting things up for the end of that channel. It's almost like, call it a climax top or a blow-off top or something like that. So what has happened with Rensselaer since? Well, it's been a dog. And but it's been a dog within what looks to be now possibly a triangle, excuse me, not a triangle, a wedge that if it does its thing, you know, SOL could take more and more people to the point to where they feel SOL, because I think that I don't think this thing's done yet. I think it's going to sell back even more. You know, we could look at this and even say that from here to here, we've got something of a either a double top kind of a pattern here and here, or you could even say that this is kind of a lopsided topping pattern. And so I'm staying away from this. I thought it looked pretty good when it was coming back to these levels, but when it failed to get over this line and it started to sell back down and get under the high eights, the handwriting was on the wall. Sometimes you get a pattern that kind of defies one line, and Sunesis Pharmaceuticals is one of those. And so I just want to show you what I'm looking at, and I've got a position in this, and I want to tell you why. The first reason is this long-term downtrend was solidly broken, and then back tested again, plus a little bit, came down to this level again, and now it looks like it's headed back up. The pattern, and again this is a weekly chart, so let me go to a 2-day. What I want to look at is this area after this big breakout. And you could see if we line this up exactly with the top of that candle, these back tests line up so nicely. When I see that, it's like, gee, you know, how can you not? The danger, of course, is you make your move here and you get a little something to tease you, and you're expecting it to move back up, and then you come back down for that second test. That's not that unusual. However, if you draw a line over these extreme peaks right here, then you can kind of get the feeling that this never really got out of that. So again, it's not a perfect thing. As a matter of fact, that's one line I've drawn with Sunesis. I've also taken this line and extended it here, and that is where I made this last trade, which was at in the low 260s just a few days ago, and seeing what appears to be a pretty clear break on decent volume, and got a pullback, and all of this is lining up nicely, at least for now, in an ascending channel. So let's make a, we'll make a parallel to that and put it there. So that's kind of what I'm looking at, and I'm thinking, you know, if this gets on up to the mid threes or something like that, I'd probably take it and sell it for what about a 30-something% gain. But the tendency, frankly, of these patterns, when they are a wedge, is for eventually the price to climb back to the high that was in place before this thing started selling down. That would be pretty impressive. I'm certainly open to that idea. I'm not thinking it's going to happen anytime soon, but again, you know, a couple of years from now, we could look back at Sunesis and go, well, you know, there's that There's that wedge, and by golly, what happened? There's that $13 where we are now. That would certainly be nice. Now I want to look at a chart, and I think this is going to be the last thing we do. This is Ford Motor Company. Again, looking at it on an arithmetic chart, you can see how it's really exaggerated, but when we look at it on a logarithmic chart, it just looks much more manageable, much easier to see what's going on. I want to show you something, though, that really is just doggone freaky about Ford. It made what kind of appeared to me to be a descending triangle with the neckline, or not the neckline, but with the flat line bottom of it being roughly at $6.50. And you can see that there's a pretty clear trend across these tops. Clearly that's a downtrend. Okay? And then it broke down, recovered, broke down a second time, then did a back test. Now I just want to challenge you to put yourself in the position of making a call back in 2008. When this broke down decisively, then back tested this line, if you had measured the height of this pattern, and again this is on a log chart, and you said, you know, I believe Ford has a target of, and you measured this, and you said, oh, it's got a target of about $1.04, and this thing was up in the $4.55 range, and you'd gotten on a Yahoo message board and said, guys, you need to be careful here. This pattern has a target of about $1. I wonder how many people would have thought you were absolutely out of your mind back in the middle of 2008. But I want you to see what happened. And the reason I'm showing this to you is even in cases where we're dealing with moves of stocks that were up in the 30s, when they break down, it sure looks to me like this logarithmic chart shows where that should have gone. Now let's pretend like we were doing this on an arithmetic chart. Okay? So here's our triangle. Okay? And we define it. It's not as easy to define. Alright? There's our move. And we say, let's measure what is the implied move from this. And you say, my goodness, it's negative $26. That makes absolutely no sense, does it? So you can see how that arithmetic chart really screws things up. There would be absolutely no way you could trust that. But when you look at it on the log scale and you draw your lines based upon logarithmic charting, even in an extreme case, it's amazing how that got it to within just a few cents of where Ford ended up going.